Most people think silver is just a cheaper version of gold. That one assumption alone explains why so many investors miss what is actually happening beneath the surface of the financial system. Silver is not simply a metal you buy when you cannot afford something better. It is not a novelty asset. It is not a speculative toy. Silver is one of the few assets in the modern world that sits at the intersection of money, industry, technology, and geopolitics. And when those forces collide, markets do not move quietly. My name is Pete Profit. I have spent over 2 decades studying financial cycles, market behavior, monetary policy, and how wealth is actually built over time. I have watched bubbles form, collapse, and form again. I have seen assets dismissed for years, only to suddenly become essential. And I can tell you with certainty that silver is one of the most misunderstood components of the global financial system today. If you are looking for quick profits, this is not your asset. If you are looking for long-term financial positioning, capital protection, and asymmetric opportunity, then silver deserves your attention. What you are about to hear is not hype. It is not social media speculation. It is not fear-based selling. It is structural analysis based on how markets behave when debt expands, currencies weaken, energy systems shift, and governments intervene. By the end of this, you will understand why silver is increasingly discussed behind closed doors by professional investors. You will understand how silver behaves differently from gold. You will understand why industrial demand is fundamentally altering supply dynamics. You will understand how policy, geopolitics, and monetary cycles influence pricing. And most importantly, you will be able to decide for yourself whether silver belongs in your financial strategy. This is not about chasing trends. This is about positioning ahead of them. For most of modern financial history, silver has been viewed through the wrong lens. People see it as a volatile commodity that occasionally spikes and then fades back into obscurity. What they fail to recognize is that silver is not just a commodity, it is also a monetary asset. For thousands of years, silver functioned as money. It was used for trade, savings, and settlement long before modern currencies existed. Even today, silver retains that monetary DNA. At the same time, silver has become one of the most critical industrial inputs in the global economy. It is essential to solar panels. It is essential to electric vehicles. It is essential to advanced electronics, medical equipment, water purification systems, and modern infrastructure. This dual role makes silver unique. When confidence in currency weakens, silver behaves like money. When economic activity and technology expand, silver behaves like a strategic industrial resource. When both forces occur at the same time, silver does not merely appreciate, it revalues. That distinction is everything. Revaluation is not a gradual process. It is not linear, it is discontinuous. It happens when markets realize that price no longer reflects structural reality, and once that realization occurs, capital moves rapidly. That is why understanding silver today is not about predicting the next month. It is about understanding where the system is heading. Let us begin with the environment we are living in. Inflation may appear controlled on official charts, but real-world costs tell a different story. Housing remains expensive for most Americans. Energy costs fluctuate, but remain structurally elevated. Insurance premiums continue to rise. Healthcare expenses rise faster than wages. Education costs remain stubbornly high. Even when inflation statistics improve, purchasing power erosion remains embedded in daily life. People feel it at the grocery store. They feel it at the gas pump. They feel it in rent, utilities, and medical bills. Investors know that inflation is not just a number. It is a process. It is the slow dilution of currency value over time. That is why capital moves toward assets that cannot be printed. Hard assets historically perform best when trust in fiat currency weakens. Gold has always served that function. Silver, however, adds an additional dimension. Gold protects. Silver has the ability to multiply outcomes when cycles shift. This is not speculation. This is how smaller, thinner markets behave when capital flows into them. Silver does not respond smoothly. It responds asymmetrically. It stays undervalued longer, then it reprices faster. This is why silver has historically outperformed gold during major precious metals bull markets, not because it is safer, because it is structurally mispriced longer and then corrected more violently. Gold stabilizes portfolios. Silver has the capacity to transform them. One of the most important analytical tools in precious metals investing is the gold-to-silver ratio. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. Over long periods of history, this ratio averages between 50 and 60. During times of economic stress, it expands dramatically. It has reached 80, 90, and even over 100 during crises. But here's the pattern most investors miss. Every major silver bull market begins with a collapse in this ratio. That collapse signals that silver is repricing relative to gold. It tells you that silver is no longer being valued as a secondary asset. It is being valued as a monetary and industrial necessity. Right now, the ratio remains elevated compared to historical norms. That suggests silver is still undervalued relative to gold. This is not opinion. This is relative valuation based on centuries of market behavior. Investors often ask whether silver is expensive. The better question is whether silver is expensive compared to gold. Relative valuation, not nominal price, determines long-term opportunity. When that ratio normalizes, silver historically experiences outsized gains. This is why professional investors track it closely even when the public does not. Another factor that separates silver from most assets is its consumption. Gold is stored, silver is used. It is embedded in physical infrastructure. Every solar panel requires silver. Global solar installations continue to expand as governments push for energy transitions. Every electric vehicle contains more silver than a traditional gasoline vehicle. As EV adoption increases, silver demand rises with it. Data centers and artificial intelligence systems rely on advanced circuitry. That circuitry requires silver's unmatched conductive properties. Medical devices, imaging equipment, and sterilization technology all depend on silver. Water purification systems use silver for antimicrobial properties. Modern electronics require silver at scale. This is not optional demand. This is functional demand. Here is the structural problem. Silver supply cannot scale quickly. Most silver is not mined as a primary metal. It is produced as a byproduct of copper, lead, and zinc mining. That means silver production does not respond directly to silver prices. Even if silver prices double, supply does not automatically increase. New mines take years to plan, permit, finance, and construct. Environmental regulations, geopolitical risk, labor constraints, and capital requirements slow development. Further, demand, however, is accelerating now. Rising demand combined with inelastic supply creates mispricing. Mispricing creates opportunity. This is not a short-term trade dynamic. This is a structural imbalance that builds pressure over time. At this stage, many investors raise the controversial issue of market manipulation. Is silver artificially suppressed? This is a difficult topic because it is often discussed emotionally rather than analytically. The reality is that silver trades heavily in paper markets. Futures contracts, derivatives, and unallocated products represent far more silver than physically exists. This creates a system where price discovery is influenced by leverage rather than physical supply. In periods of low physical demand, paper trading can dampen price movement. But suppression does not eliminate value. It delays repricing. History shows that when physical demand overwhelms paper leverage, price does not move gradually. It revalues quickly and forcefully. This has occurred in multiple commodity markets over time. Silver's history contains numerous episodes where price was constrained for extended periods before sudden revaluation. Markets can ignore structural imbalances only for so long. Eventually, physical reality asserts itself. When that happens, price adjusts not to what participants believed was fair, but to what supply and demand require. Silver's past has been shaped by this dynamic. There is no rational reason to assume its future will be different. Professional investors do not seek certainty, they seek probability. Markets do not reward waiting for perfect clarity, they reward those who position ahead of consensus. There are 3 dominant macro scenarios for silver over the next several years. In a soft landing economy, silver trends higher as inflation hedging and industrial demand persist. In a recession, silver may decline initially as liquidity contracts and investors sell assets indiscriminately. But once monetary easing begins, silver historically rebounds aggressively as capital seeks protection from currency expansion. In a monetary confidence crisis, silver does not simply rise, it is revalued. In such environments, Investors stop asking what silver is worth in dollars. They ask what dollars are worth in silver. This is not fear-based thinking. It is historical precedent. Silver performs best when systems strain, not when they operate smoothly. Another overlooked dimension of silver is how supply constraints shape long-term pricing. Silver is not scarce in the sense that it is disappearing. It is scarce at current prices. This distinction is critical because silver is largely a byproduct metal. Production does not respond quickly to price incentives. Even if demand were to double, supply could not match it in the near term. This creates upward pressure that is structural rather than speculative. At the same time, governments increasingly recognize silver as a strategic material. Energy infrastructure, technological development, defense systems, and medical applications all depend on reliable access to silver. Strategic classification often distorts markets. It introduces political priorities into resource allocation. This typically results in mispricing and inefficiency. Hard assets historically benefit when policy interferes with free markets. Silver sits at the intersection of industrial necessity and monetary relevance, making it uniquely sensitive to these distortions. The next question every disciplined investor must answer is how to gain exposure. There is no single correct method. Each vehicle serves a different purpose. Physical silver offers sovereignty. There is no counterparty risk. What you hold, you own. This appeals to investors who value direct control and long-term storage. Exchange-traded funds provide liquidity and convenience. They allow exposure without storage, insurance, or logistical complexity. Mining stocks offer leverage. They can outperform the metal during strong markets, but introduce operational, regulatory, and management risk. Futures provide the highest leverage, but require professional risk management and discipline. Most experienced investors diversify across multiple vehicles based on their objectives, time horizon, and risk tolerance. The most common mistake is not choosing the wrong instrument. It is having no exposure at all. When structural repricing occurs, those without positioning are left reacting rather than participating. Silver does not exist in isolation. It is deeply influenced by geopolitics and government policy. Energy mandates increase demand. Trade restrictions disrupt supply chains. Tariffs and export controls distort pricing. Monetary policy inflates hard assets when currency credibility weakens. The United States is actively reshaping its energy, manufacturing, and technology infrastructure. These shifts require vast amounts of silver. At the same time, geopolitical fragmentation is increasing. Global systems are becoming less integrated. Supply chains are being localized. Strategic materials are being prioritized for national security. This environment favors tangible assets. Silver benefits from fragmentation because inefficiency increases the value of physical supply. When policy becomes more aggressive, markets become more distorted. Hard assets historically outperform in such conditions. Silver, due to its industrial necessity and monetary heritage, is uniquely positioned at the intersection of these forces. At this point, most investors ask the same question. Is now the right time to buy silver? This is a natural question. It is also the wrong one. Markets do not reward waiting for confirmation. They reward positioning before consensus forms. Silver does not move gradually once sentiment shifts. By the time mainstream narratives turn bullish, much of the asymmetry has already disappeared. Long-term investors build positions during periods of skepticism, not during periods of excitement. This does not mean buying blindly. It means understanding valuation, structure, and probability. It means accepting that uncertainty is the cost of opportunity. It means recognizing that discomfort is often the signal that you are early rather than wrong. Silver is not a speculative bet. It is not a short-term trade, and it is not a fringe asset. Silver is a strategic allocation in a world defined by debt expansion, currency debasement, energy transformation, and geopolitical realignment. Those who understand cycles prepare early. Those who ignore them react late. The greatest risk in markets is not volatility, it is complacency. Wealth is not built by chasing trends, it is built by positioning ahead of them. Silver may not dominate headlines, it may not be discussed at cocktail parties, but history shows that when the structure of the system changes, silver does not whisper, it moves decisively. I am Pete Profit. If your objective is financial freedom and retiring wealthy, Silver deserves disciplined, informed consideration within your long-term strategy. Subscribe for deeper market intelligence and ask yourself one final question. Are you simply watching silver, or are you already positioned? Thanks for watching. I will see you in the next video.